Hey everybody, it's Joey from Universal CPA Review. Some of you might know me as Ask Joey. If you're studying for the CPA exams and you consider yourself to be more of a visual learner, you've come to the right place. So don't forget to subscribe to our YouTube channel, join our Facebook study groups, and our Reddit community. You can find the links to those in the description below. Hedging and derivatives. What is this, the CFA exam? I didn't sign up for this. So there are two focus areas that we need to draw our attention to. So we're going to talk about both hedging and the use of derivatives. So while they do go hand in hand, they need to be differentiated in our brain. So when you think of hedging, you're thinking about the act of mitigating our risk. And when you think of derivatives, you're thinking about how it is that we are ultimately going to be hedging that risk exposure. Okay, so we have two parties that we're going to think about. We're going to think about Nervous Nelly, and we're going to think about Big Mike, the broker-dealer. Okay, so Nervous Nelly is a little bit concerned about the markets. So they're thinking about offsetting some of their risk somehow. They think they have too much exposure, right? So they're sitting there and they're contemplating. They're discussing in-house. They're saying things like, well, gee, guys, the market seems to be awfully volatile right now. Maybe we should mitigate our risk exposure by purchasing some derivative contracts. So they're going to call up Big Mike, the broker-dealer, because they know that Big Mike is aggressive and will work something out. Right, Big Mike is a Wall Street broker-dealer. He's out here like, what are we doing? What are we doing? Are we buying? Are we selling? Don't get me on the line if you're going to waste my time. Alrighty, so if Nervous Nelly wants to hedge their risk exposure, they're generally going to do this through a broker-dealer like Big Mike. So going forward, I want you to separate the terms hedging and derivatives in your brain, because hedging is, like we said, the act of mitigating one's risk. And they'll be doing this by applying a derivative contract. So think of purchasing a derivative contract as purchasing an insurance policy, right? A lot of people love to get spooked on this topic of the exam, right? They think hedging and derivatives, this is crazy stuff, all right? But I'm here to tell you, there is a roadmap. So we got to simplify this in our brain. We got to build that mental map. All right, so the first step in our mental map that we're going to cover is going to be the act of hedging. And there's two ways that we can hedge. We're going to talk about a fair value hedge, and we're going to talk about our cash flow hedges. Then we're going to talk about the four primary derivatives. Okay, so we got to know the four primary derivatives for the exam. This is going to consist of options, swaps, forwards, and futures. So think of these as contracts themselves that we are agreeing to. Right, the reality is a derivative contract can be a rather complex calculation in the real world. But the good news is, in the CPA exam world, this is going to be tested at a high level. Right, we're mostly going to be focused, like we said, on question number 1 of our two primary questions. And that's ultimately going to be where in the financial statements are these going to get reported. Okay, so let's go through a few of the key terms before we dive into the nitty-gritty. We got to know the differences between the notional amount and the underlying amount. So what is the underlying amount? The underlying amount is the amount that we're betting on, right? This is what we're using our derivative contract for. So if we're purchasing a derivative contract on a foreign currency, the underlying amount would be, say, the peso or the yen or the British pound, whereas the notional amount is going to be what it is that we are using to calculate our gain or loss from this transaction. So you could think of this as a specified unit of measure. Okay, so the notional amount can be measured in things like pounds or tons or bushels, right? Maybe we got some bushels of wheat. So got to know the differences between the underlying amount and the notional amount. An additional term that we got to know is the exercise price, right? So this is the price that is also known as the strike price. So this is the price that is agreed to during the exchange rate options contract, right? Ultimately what's happening here is when Nervous Nelly and Big Mike are negotiating that options contract, they're ultimately going to be negotiating the exercise price on that option. So that's either going to be the price to purchase or sell it. Whereas the spot rate is going to be the price that is quoted for immediate settlement on a commodity or security or a currency. So this is also known as the current market value of the asset at the moment of its listed quoted price. All right, the foreign exchange rate is going to be the rate during the exchange of currencies at some exact point in time. Okay, and we're going to elaborate a little bit more on this when we talk a little bit more about foreign currencies. All right, let's dive face first into our mental map. Here we go. Step 1 of the mental map, we're going to talk about the concept of hedging. And there are two types of hedges that we really need to zero in on. So we're going to talk about both fair value hedges and cash flow hedges. So what's the difference between the two? Fair value hedges mitigate the risk of fair value variability on assets, liabilities, or firm commitments that the company already owns. Whereas cash flow hedges are going to focus more so on the mitigation of risk related to cash flow variability on assets or liabilities. Okay, so with that being said, we're ultimately going to hedge both our fair value risk and our cash flow risk by the use of our 4 derivative contracts, which we'll talk about more in step 2. But before we dive into our different derivative contracts, let's elaborate a little bit more on the 2 types of hedges that we're going to focus on. Okay, so let's start by talking about our fair value hedge. So let's say that Nervous Nelly is awfully nervous about the volatility of the market, but specifically, this is talking about the fluctuation in the fair value of assets and liabilities that Nervous Nelly already owns. Okay, so something else that's a little bit unique about fair value hedges is that they can be used to mitigate the risk of changes in the fair value of assets and liabilities or other firm commitments. Okay, so this is different from a cash flow hedge in that cash flow hedges can only be used to mitigate the risk of changes in variability of cash flow associated with assets, liabilities, or forecasted transactions, all right, but not firm commitments. Only fair value hedges can offset the risk exposure for firm commitments. Okay, so real quick, what is a firm commitment? This is essentially a promise to do something within a specific period of time. All right, so generally we're talking about security offerings. All right, generally we're talking about the underwriter committing to buy or sell securities. Okay, so something miscellaneous to note. And fair value hedges move in the opposite direction of a hedged item. Okay, so Nervous Nelly can use the strategy to potentially cancel out its future losses. Whereas a cash flow hedge can mitigate the risk that is associated with sudden changes in cash flow of assets, liabilities, and potential forecasted transactions. All right, but take note, once again, not firm commitments. So there are many factors that could bring out these sorts of changes. So this could be due to an increase or decrease in foreign exchange rates, changes to interest rates, or asset prices. Okay, but when it's all said and done, the primary questions the exam loves to ask related to step 1 is going to be what we're going to discuss in step 3. And again, that's question number 1, which is where this is going to be reported. All right, so let's hang tight. Okay, so now that we have a fundamental understanding of our 2 types of hedges, right? We have our fair value hedge and our cash flow hedge. We're now going to talk about how we're going to apply these hedging strategies by using our 4 derivative contracts. Okay, so we're using our mental map as a roadmap, right? Step 1 is going to flow into step 2, which is going to flow right into step 3. So it all comes full circle. So what is a derivative? This is a financial instrument that is going to have its own specified value. So the value of that derivative is going to come from these financial instruments, and they're going to be based on the performance of another item, right? So for example, if we're applying a derivative to an asset, the value of this derivative will be derived on the fluctuation in fair value of that asset. So let's say, for example, that Nervous Nelly is investing in energy stocks. If the energy stock that they're investing in is particularly volatile, in which case that might make them a little bit nervous. Okay, so our 4 derivatives that we need to know are going to be options. We're going to need to know about swaps. We're going to need to know about forward contracts and futures contracts. Okay, so let's start by talking about option contracts. Okay, so we're saying now that Big Mike the broker-dealer might be trading options all day long. So Nervous Nelly wants to purchase an option contract. So that means that they're doing literally what it sounds like. They are purchasing the option to either purchase or sell the stock at a specific price. But at the end of the day, this is still a derivative contract, right? The ultimate purpose is they're taking a risk. So they're paying for this premium to have this quote unquote insurance policy, and the option is giving them the ability to purchase this or sell it at a locked in rate. So we have a call option and a put option. If Nervous Nelly is purchasing a call option, that means they're taking an investment strategy that allows for the company to purchase stock with the expectation that the price of the stock is going to rise beyond the current stock price. So the hope here is that that's going to rise before the option's expiration date. Okay, so we're going to have a call option with a strike price that has an expiration date. When you think of a call option, you think of literally calling the option back. Okay, so calling equals buying. Whereas if we have a put option, we're selling. So if we have a put option, we're going to be making money if the price is going down in value. Okay, so again, think of this as an insurance policy. Worst case scenario, the stock goes up in value and we don't exercise this option. So in which case, Nervous Nelly would only lose the amount of money spent on the option. So frequently you're going to see a fair value hedging strategy when purchasing these option contracts. Okay, so let's say the Nervous Nelly owns stock with a fair market value of $100,000. Nervous Nelly is concerned that the value of the stock is going to go down to $80,000 at the end of the current year. So in order to offset the risk that the asset's fair value will decrease in value, the company purchases an option contract that has a value of $100,000 to offset this position. Okay, because Nervous Nelly is in an offsetting position, the fair value of the derivative contract will move in the opposite direction of the hedged item. So this is going to ensure that they're covered against potential changes to the fair value of the asset. So what's key to note is that this is offsetting the risk exposure of the fair value fluctuation in the asset. But also keep in mind that this could also be a liability. Okay, so these assets and liabilities are those that the company already owns. So in this case, Nervous Nelly already owns the stock sitting on their books. They're just worried that the fair value is going to decrease and they want to lock in the position at that $100,000 rate. Okay, so how about swap contracts, derivative contract number 2? So this can also be used when a company is nervous about the fluctuation in the fair value of assets or liabilities that they already own. So this can frequently be seen when there is a situation related to a company engaged in some sort of debt agreement with a fixed interest rate. So now let's assume that Nervous Nelly issued bonds to Aggressive Al in the amount of $100,000 with a 5% annual interest rate, right? So Nervous Nelly now issued this debt with a 5% annual interest rate at the beginning of the year. But the reality is this interest rate could be fluctuating throughout the year, right? As interest rates go up, they're going to be locked in at that 5% annual rate. So that might make them a little bit nervous. So what are they going to do? They're going to get Big Mike on the line and they're going to say, well, gee, Big Mike, we're awfully nervous about the fluctuation of this interest rate. We're locked in at a 5% rate. We want to offset some of our risk exposure that this isn't going to go up in value, right? So Big Mike's going to be like, sure, no problem. So essentially, they're going to engage in this fixed interest rate swap. So this will essentially reopen this 5% rate, which will result in an interest expense that varies based on the market rate. So we're going to see changes in fair value. They could go up, they could go down, they could go sideways. But at the end of the day, what we need to know is this. We need to know how we're going to report unrealized gains and losses in the financial statements. Okay, so moving into step 3, and what we need to know about fair value hedges is that we're going to account for this potential gain or loss as the change in the value of the derivative contract itself, right? What we talked about in step 2, right? We're talking about those options or the swaps, or the change in the value of the hedged asset or liability, right? We have this derivative contract, which is separated from the asset or the liability that is potentially fluctuating in value. Okay, but most important takeaway is that when we're talking about fair value hedges, the gains or the losses will always be reported on the income statement. Okay, so we're not off the hook just yet. Now let's talk about our forward contracts and our future contracts. So the key to note here is that this is not going to require an initial purchase. So although that we are still mitigating our risk, we're not going to be paying upfront for this insurance policy, right? We aren't spending money like the way we would if we were buying an option contract. So our future contracts and our forward contracts are very similar, but there are a few key differences that we need to talk about. Okay, so forward contracts are going to end up being traded privately, whereas future contracts are going to be those that are traded on a stock exchange. Okay, so we're going to be using future contracts when we're trading securities. Okay, so how about liquidity? So future contracts generally are going to be a little bit more liquid, whereas forward contracts are not going to end up being as liquid. Okay, so obviously, if they're being traded on an exchange, then future contracts are going to be a little bit more liquid, right? High frequency trading for public companies. Okay, which ultimately means a little bit easier to sell when the time comes. So futures contracts are going to be industry standard, whereas forward contracts can be a little bit more customized. Okay, so a little less wiggle room for putting together a future contract. So the contract terms could be between Nervous Nelly and Big Mike, right? The two of them would be outlining the parameters of the settlement of the futures contract. This would be done daily, whereas forward contracts are going to be settled at the end of the period. So here's the deal. If we're on, as the cool finance kids call it, the buy side, that means we're in a long position. Okay, so let's say that Big Mike is on the buy side of a foreign currency transaction, right? Let's say that we're long the yen. That means that if we're going to make money, this is going to happen if profits go up. If, on the other hand, we're on the sell side, we're shorting the yen. Okay, so if we're shorting, we're going to make money if profits go down. Okay, just like when the housing market collapsed, the few that shorted the housing market made a ton of money. Okay, so long equals buy side, which equals money is made if profits go up, whereas shorting equals sell side, and money is going to be made as profits go down. Okay, so we went through a few fair value hedging examples. Now let's go through a few cash flow hedging examples. So let's say that Nervous Nelly wishes to purchase 100 tons of metal that sells for a price of $2,000 per ton. So Nervous Nelly would expect to spend around $200,000 for this metal. However, if the price of metal spikes to $3,000 per ton, then they would be left with around $100,000 in expenses that they weren't anticipating. So what are they going to do about this? Well, they can use a cash flow hedging strategy. Okay, so for example, if Nervous Nelly got a company like Metal Inc. on the line because they know that they work in the metal industry, they can work out a forward contract privately. Okay, so even if metal prices rise, now Nervous Nelly's net payment would remain the same. This would make the forward contract a hedging instrument that would be deemed effective. Okay, so same story if this is a futures contract, only now we're saying that Big Mike is on the line, right? Big Mike's the broker-dealer who's trading on a public exchange. Okay, but the bottom line is we're hedging the variation of cash flow with this derivative contract. Okay, but again, can't stress this enough. The most important takeaway here when we're talking about fair value and cash flow hedges is where this is going to be reported in the financial statements, right? Question number 1 of our 2 big questions. We said that gains and losses from fair value hedges would be reported on the income statement. What we need to know about cash flow hedges is that gains and losses would be reported in the statement of other comprehensive income if they are deemed effective. Well, guess who's back? Back again. FOOPy's back. Tell a friend. Okay, so bringing back our FOOPy mnemonic. Remember the E in our FOOPy mnemonic. We're talking about the effective portion of a cash flow hedge. So if this cash flow hedge that Nervous Nelly has engaged in is deemed effective, right, the effective portion of that cash flow hedge is what is reported in OCI. Okay, so if it is effective, this means that the hedging strategy worked. They made some money. This portion is what would be reported in other comprehensive income. And if for whatever reason the cash flow hedge was deemed ineffective, then this would be reported on the income statement. All right, so primary focus when it comes to step 3 is how this is going to be reported. Something else to note is that all derivative instruments will be measured at fair value. So when I say that, I'm talking about the contract itself. Okay, so at the end of the day, as you can see, the key difference between a cash flow hedge and a fair value hedge is the hedged item. With a cash flow hedge, you're hedging the changes in cash inflow and outflow from assets and liabilities, whereas fair value hedges help mitigate the exposure to changes in the value of the asset or the liability. Okay, so while fair value hedges are most suited for fixed rate items, the benefits of cash flow hedges make them ideal for variable rate items. Okay, but like we said, for the exam, you should understand this at a very high level.